Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, March 14th, 2022. It's 10:23 a.m. Eastern Time as I'm starting the video, and we'll keep this one short. Brief update on the equity markets. I'm going to update crude oil, gold, silver. I got a post out to you guys this morning. Buy points on those. Coming up on one potentially on crude oil, and I'll do an update on the recent lumber trade and Treasury bonds. We'll probably look at as well. All right, so just to recap, I gave you this end of week. We had an additional check mark with a red candle. This is last week candle. Here's where we're at today. We're up today. Remember, a weekly candle is going to form throughout the week, so we'll just wait and see how this closes. On a related note, keep in mind that the FOMC meeting is this week, so Wednesday at 2 p.m. they'll make the announcement. It's about all but a baked in the cake. They're going to be a quarter-point hike because Powell. Why, for the life of me, I don't understand, 3 weeks ago or so said that's what he was going to vote for. It's really going to be about more what they say. But at this point, look, the markets are going to do what they're going to do based on supply and demand. Powell and the Fed have been doing absolutely virtually nothing. They've tapered the bond program, but they've done virtually nothing to quell inflation other than jawboning. And that's what you do when you don't have many arrows left in your quiver. And of course, now it's the Russia-Ukraine. What's it going to be next? There's always going to be an excuse. There has been excuses all along. The big consensus is he's got to walk a fine line. He doesn't want to rile the markets because of, they're blaming Ukraine what's going on. Markets peaked, because they peaked, based on the technicals. Ukraine's just the fundamental kind of thing that's tying in, and it is a real thing, so I'll acknowledge that. It's certainly something to be aware of. But the bottom line is, again, back to what I was saying, is expect volatility this week. Don't read too much into it, and with that, a Fed week, those especially market moving Fed weeks, they're not all. The Fed sometimes meets, and the market knows there's not going to be any changes, doesn't expect anything. Volatility's low. Those are really not much to be concerned about. This week, I would tell you expect volatility, and because it's a Fed week, and with the we're already in a volatile period. The VIX is already elevated. You can expect big swings and whipsaws. Whipsaws are more than common. So what I tend to do is be a little more liberal, a little loose on the stops. I'll sometimes pull stops or widen those. I'm here in front of the computer all day, so if you don't have that luxury, you don't maybe walk away without a stop completely. It's up to you, depending where your entry was and how risk adverse you are. Again, trying to, talk in the realm of, risk adverse trader or even investor is almost an oxymoron. Investor somewhat, but traders, you're taking risk. But there are some are obviously more risk averse than others, and I just wanted to point that out. So expect volatility, and barring anything crazy by Wednesday afternoon, and even then I've always strongly encouraged do not read too much into the initial reaction from an FOMC announcement, and even then the subsequent reaction can sometimes be faded. What I mean by that is usually there's a big rip or dip right away at 2 p.m. and that rip or dip can be faded and it can go the other way. In other words, just try not to read too much into that. The market just runs around like a chicken with its head cut off, with both humans and algos trying to parse the data and what the Fed said and what they might do. And so at the end of the day, this is still my guide right now for longer term trades and positions. It's the weekly chart. So we'll see where this goes. And at this point, even if that downtrend line I just drew right here gets taken out, we'd have to move well back above my first target for me to really even take note, if you will, or really be concerned. And then you still have the big 200-day, 40-week moving averages, and then that level. So everything I've talked on before, nothing's changed there. Let's see what happens this week. Again, just expect volatility. Take it down to a 60-minute chart. This is simple stuff. If you're just trading more actively, we're in a downtrend, and we have been walking lower, and that's it. Let's not make too much of it. We take out the trend line, and then we start taking out horizontal price resistances above that, taking out reaction highs. That starts to change things, especially near term. And then, when things change near term, it has the potential to change things longer term. But as of now, we had another check mark on the weekly last week, which keeps me in sell the rips, cover the dips or don't cover. It depends on how active your trading mode. So that's that for now. Let's not spend any more time on the markets. Let's talk about where the money is. I think the opportunities today. Well, that brings me to gold and silver. Got a post out to you today. Feel pretty good about these buy points. And so you have silver at this is gold. I'm sorry. Gold at that trend line. I gave you a couple pullback levels, which would be objective to add on, but this is one I really wanted to see, and we got it. So this to me is a again, please understand when I say all in, it doesn't mean my whole portfolio. Back to a full position in gold. Gold's in an uptrend. It recently had a very bullish breakout on the weekly chart, and this is what I look for. If it goes down there, I we'll see whether I add to a position or not. But either way, I'm back into gold, and I think this is an objective entry. You can have a stop below. You can have a stop below here. If it takes out this trend line, and by the way, a little slight break, especially with the impulsive selling lately, is almost to be expected. I call that a momentum fueled overshoot. So as I said or showed you in the charts this morning, we also have potential bullish divergence as well. So I really like gold and silver here. Doesn't guarantee it'll pay out, but that's where I took it up. Silver as well, same story. We're also on a 60-minute chart. There it is. There's your uptrend line. You had the minor uptrend line broken and back tested. Remember, we were at resistance in gold when we hit the other day, and that's where the correction was. The gold previous bull market high from over a year ago, and also nice positive divergence right here on silver as well. Yeah, I don't know how you don't like this. To me, this is my kind of setup. Again, doesn't mean it'll play. Doesn't guarantee it'll play out, but this is how I'm trading it. And I showed you a little kind of scenario. So obviously, it'd be helped to see us regain 25,673. Remember, that was also a support level on the way down, and we hit it and we bounced. That's when we took out the minor trend line. We back tested, bounced, back tested the trend line. And so these are the resistance levels overhead, and they'll give check marks. So we need to hold this trend line. Obviously, that's the first check mark if you're buying at it, and give it a little bit of room. If you wanted to trade actively, I wouldn't give it too much room. 60-minute close, solid 60-minute close, maybe two 60-minute candles below if you want to play it safe. But then, boom, if you let's just say you don't like buying pullbacks as support. Let's say you're the kind that says, no, silver's in a near-term downtrend. I want to see more bullish evidence. Well, you can wait till it pops back above 673. That would certainly help. And then again above 26,382. Those are your overhead resistance levels. I know it looks like a head and shoulders pattern there, and maybe it'll play out that way, but usually these are supposed to be on longer term time frames. But if so, that'd be your measure target, and we could go down farther in silver. And I may like it down there as well. I don't see why I wouldn't, unless the breakouts fail that just happened on the weekly chart. From a longer term perspective, for the time being, I will view pullbacks to support as objective long entries in gold and silver. And if you ask me my opinion, I think this is probably it. This is probably where pullback ends, with another thrust up now, another leg up. And guys, it goes without saying, I know I'm using the futures because they're just more round-the-clock trades, more to look at. To be bullish silver gold futures is to be bullish the ETFs, if that's your thing. GLD, SLV, even the miners should follow the metals. Crude oil gave you comparable trend lines recently. This is also a 60-minute chart, just like we were looking at on gold and silver. And I have two different trend lines that I've been targeting, and that's my ideal buy zone right here for crude if it gets there. So remember last week we had a support zone here about 107 to 105.15 up to 107, and we danced on it for a little while last week. We had a couple bounces. We even had this little bear flag type action there. We went down out of the flag, but kept hitting the bottom of that support around 105, but we took it out today. So we also have a near-term downtrend. So here's my scenario for crude oil. I'm going to tighten it up here. It looks a lot like gold and silver. I think we'll get another thrust down, and anywhere from here you might want to step in, start buying there. That's probably where I'll start layering in down to, but not too far below that trend line there. It's a relatively small window, and then what happens, if that happens, that was just from last week, my target saying another 10% downside measure target. Let me remove that line. Here's what it would look like if this happens. If we get a pretty good down move today and we're into tomorrow, you're going to have positive divergence here. You already have potential divergence. You have higher highs in the indicators right now as prices make lower highs. That is bullish divergence, but I like to see it confirmed, get a bullish crossover soon. So again, maybe not even down that far. You might want to start scaling in soon if you want to be long crude. I told you before, yeah, it's very news driven. If you're somewhat risk averse, stay away. Because headlines, this is very headline driven right now, but it does trade well to the technicals. I showed you that last week. I had a short trade here on a break of that uptrend line, divergent high, pullback trade, and so then that's it. So you have support runs from about, I'll tell you right now, if you want a dollar number, it's about 98, a little above $98, around 98 down to about 95. That would be a buy zone for crude oil. And ideally, with a stop somewhat below, and in doing so, could put in a nice divergence. Look, we have the divergence now. It could reverse shy of that. Just keep that in mind. So, you want to start scaling in now. CL is the regular crude futures contract, but you also have a mini contract. I think MCL is the smallest, if I'm not mistaken, and then I think it's QM. Yeah, QM. I'm sorry. This is not a drawn. It's a line tool. Q is in Q-tip. M is in Mary. Is another smaller contract, and they're all trading. Same thing. Trading crude futures, just smaller leverage factor. And of course, you have USO, which is the crude ETN. And there's leverage ones and all that good stuff. There's a lot of different ETFs and ETNs out there for crude oil. And next up is lumber. Lumber, we have a short on that. Have since a breakdown. It was posted first as a setup in this bearish, this most recent 60-minute, or this is a 2-hour chart, so 120-minute candles. It also showed it on the 60-minute chart. A bearish rising wedge pattern, just like this bearish rising wedge pattern, and just like that one, it was confirmed with negative divergence. There's your negative divergence, just like the low recently was a positive divergent low, so forth and so on. And we're up about, I think it's about 15% so far. We're good for on this one, and about 17 actually into today's lows. So wanted to point it out because we took out that second target, 125.84ish right there. We took it out on a gap down, and we're below it as well. So it was, if there's a gap overhead, maybe we backfill the gap, but this was support, and we gap below it, so we could just keep going. And that's the nature of lumber. Lumber is mostly a unidirectional vehicle. It's either going up or down. It doesn't really, once in a while have a little sideways corrective, sideways consolidation. But that's why it's like kind of like natural gas, man. When this thing runs, it runs pretty big. So, anywho, just want to mention that I still maintain my preferred target down here, what I call my minimum preferred target, where I think it's going, where I don't plan to cover until it gets there, at about 1022, excuse me, and very much a potential, especially with what I see in the stock market. I think there's a pretty darn good chance we'll continue down before all said and done to that 825-ish level there. And that would be a total, well, if the minimum target there of 1022 is hit, that's about a 22% drop and about 37% down to that 825 level from where our short entry was on the breakdown of the pattern. Okay, and a quick update on Treasury bonds. Both the 30-year and 10-year were thrown out as potential trade ideas last week. This is ZB, the 30-year bond futures. Remember, it was, and I'm not going to go into those now, but primarily I showed you on the long-term charts, the daily and weekly, some bullish developments. Then I zoomed down here to the 60-minute charts for those that want to trade futures, because bonds move so little in percentage points that you need to leverage up. Whether you're using TLT, you need to buy a lot of it to make it worth your while. That's the ETF that tracks the 30-year bond. But the futures are inherently have leverage, and so you don't, one single contract give you over 100,000 exposure to the long bond. So therefore do the math. Typical daily swings about 1%, give or take, in bonds. So you're talking a 1,000 up or down a day, can be more, usually less. And again, if it's not your cup of tea, or you don't know futures, stay away from those. But that's it. We're down 1.35%, but we're coming up to that previous reaction low, and the divergences are still intact. Last week I showed you we had divergence, but it's still, the divergence have been extended. So we broke out of this little minor trend line. We went up, remember, this is what I was showing you last week, that we had a trend line here that was broken. So we popped the downtrend line, but then hit the back test of this uptrend line and price resistance, and we got rejected there. But now we're coming up on that major reaction low, and so I still think it looks good, especially, and now keep in mind, not only are stocks going to be volatile this week, up until and immediately, especially immediately after the FOMC announcement, bonds will be as well, because this is what the Fed's all about, interest rates and bonds and all that. So anyway, I think from the longer term charts, it still looks constructive, and so and it's also a way to diversify and or hedge a portfolio. That's ZB, and then ZN is your 10-year note. We'll look at that and then wrap up this video. I promise you would be relatively brief, and just need to find my ZN chart here. Going through all these down on the bottom off the screen. You can't see that now. Where did it go? Okay, here you go. All right, ZN. This is an hourly chart. So the divergence I highlighted last week, it's still intact. On the PPO down there on the bottom, this is the RSI hanging on by the skin of its teeth. It's flatline divergence, equal lows in the RSI versus lower low in price. That's still positive divergence. So that's how it looks. And this one's still below trend. So the 10-year needs to pop this trend line. And again, the longer term charts look constructive. Shorter term, as far as the timing of the entry, again, Fed's coming up. So you're going to see some volatility here, but I think this one, still looks good, but needs to pop that downtrend line to really get going there. So that's the update on bonds. All right, so that's it. Crude oil, Treasuries, the indexes, and gold and silver. Yep, covered them all. All right, guys, let me get the video out to you, and I'll let you know what else stands out if I come across anything else. But as of now, let's keep an eye on these things. This has been Randy Finney with Right Side of the Chart. Have a great day.